Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Webull. Right now, if you deposit $100 or more, you could earn up to 20 free fractional shares by using my link in the description below. Remember, each share is valued between $3,000 and $3,000. So go ahead and check out Webull. I'll put a link to them in the description below. Also, make sure to check out the Discord, completely free to join. So I'll put a link to it in the description below as well. Now let's get right into today's video. So today I want to talk about selling puts with a small account every single day. Now, firstly, selling puts is a bullish strategy, meaning we generally want the price of the stock to go up. And remember, selling options allows us to capitalize off of theta, decay, or time passing by, as I'll show you here in a little bit. Now, one of the biggest problems with selling puts is that it can be very expensive. So let's take a look at an example here with SPY. So let's go into the options here for SPY. And let's go over to May 13th for our expiration. And let's go to sell and let's go to puts here. Let's say you wanted to sell a put at the $564 strike. So I'm going to go ahead and select this here. How much would this cost? So remember, when you sell a put, you have to put up some collateral. How much? Whatever our strike price is times 100. So if I wanted to sell this put, I would have to have $56,400 to do so. That's a lot for those with small accounts. So again, what if we wanted to do something similar to this, but without having to have that much money? So today, I'm going to show you a simple way to do almost the exact same thing with only about $100 or so. You don't have to have over $50,000 to do this. And I'm going to be using SPY here today. Now, why am I using SPY? The reason I want to use SPY is because for those of you that are not aware, SPY has daily expirations. So you can see it has contracts that expire every single day, which means if you really wanted to, you could do this every single day and generate premium every single day here. So that's why I want to use SPY. Now, let's leave the expiration date here as it is, May 13th. So the first thing you want to do here is select an appropriate expiration date. So again, I'm just going to leave it as May 13th. And again, with SPY, if you wanted to do this, you could do this every single day. But let's say I want my expiration date to be May 13th. So the next thing I want to do here is, again, I want to make sure that I'm selling options and that I'm on put options here. So the next thing we want to do is we want to determine what price we believe this stock will be above at expiration. So at expiration here on May 13th, what price do I believe SPY will be above? So let's say I believe SPY will close above 564 on expiration date on May 13th here. So in the next step here is I would want to sell a put at that strike. So where is the 564 strike? Again, it's right here. So I would come in here and sell my put. So as you can see, everything so far is the same as selling a regular cash secured put. But now, so that we don't have to, put up over $50,000 in collateral here, what we want to do next here instead then is we want to switch over to buy here. And now we want to also buy a put option. And we want to make sure the put we buy here has a strike price less than the strike of the put that we're selling. So here's the strike of the put that we're selling at the 564 strike. So the put we buy here needs to have a lower strike. So it has to be one of the puts below it here. Now I'm going to select the one right below it at the 563 strike price. So I'm going to go ahead and put this here. And so now as you can see, we're still going to get a premium or a credit. This is still going to be a bullish strategy here. So as you can see, this is very similar to selling cash secured puts. The difference is you don't have to have as much collateral here. And of course, the other difference is when you sell a regular cash secured put, you're putting up collateral in case you have to buy 100 shares of the stock. Here, you're putting up a lot less collateral, but if things go wrong, you lose that collateral. It's not like you're going to have to buy 100 shares. You're just going to lose the collateral you're putting up here. So if you take a look here, here is our collateral for this one. And so our collateral here would be $100. So how do we calculate the collateral? To calculate the collateral here, very quickly, all you have to do is subtract the strike prices you selected. So if I take 564 minus 563, I get 1, and I multiply that by 100, that's $100. That's what my collateral is going to be. So as you can see, you can calculate that very quickly. If you want to know what your max risk is, all you got to do is you got to take your collateral and subtract the credit you're receiving. So 100 minus about 45 would give us 55. So as you can see, then my max loss would be $55. So you can see, you can calculate all those things very quickly here with this strategy. Now let's quickly visually take a look at what this trade would look like, what our profit or loss might be depending on the date or the share price, those things. So remember, to do that, I like to use Option Strat. So this is a really great options visualization tool, and I'll put a link to it in the description below. Again, I think you should use this anytime before you enter a trade. It can be very helpful. So I'm going to go to build, and I'm just going to go to puts here. So let's go over to SPY here. That's what we were using for today's demo. Remember, the expiration date I selected was May 13th, but you select whatever expiration date is good for you. And remember, SPY has daily expiration. So again, theoretically, if you wanted to, we could do this every single day. So remember, the first thing we did was we looked at SPY and we said, what price do we believe SPY will be above at our expiration? I said, let's just pretend I believe it's going to be above 564. So I started by selling a put at that strike. So here I'm going to switch this to sell. So selling a put at the 564 strike. Then we said, okay, now we need to buy a put. You want to buy a put with a lower strike than the strike of the put that we're selling. So I said, well, I'm going to do the one right below it at the 563 strike. And then remember, if we want to calculate the collateral we need, all we do is we subtract the strike prices and we multiply that by 100. So here again, if we subtract the strike price, we get 1. 1 times 100 is $100 in collateral, as you can see here. If I were to select the one at the 562 strike instead here for the put that I'm buying, you can see the collateral will then be $200. Because again, if we subtract 564, we take away 562, we get 2 times 100 would be $200 in collateral. So just keep that in mind when you're selecting your strike prices. Now, if we take a look here, my credit here is almost $45. So if we want to calculate our max loss, we take our collateral minus the premium or credit we're receiving. That gives us our max loss. Max profit is going to be the credit you received, so almost $45. If you have the premium version of Option Strat, you can see what your chance of profit is according to Option Strat, so 52%. And we also get our break even here. Now let's take a look at this chart. Again, this is where it can be very helpful to potentially see what our profit or loss might be depending on the date, depending on the share price here. Now remember when I mentioned earlier that when we sell options, it allows us to capitalize off of theta decay, or in other words, time passing by. We can see this here. Where can we see this? So we can see this right here. Notice that if there's no change, there's a 0% change in share price after we enter this strategy. Let's say it stays at that same price. If you take a look here, you'll see that your profit starts to increase. So you'd have a $2 profit, then a $3 profit. Then the next day you'd have an $8 profit, then 9, then 10, then 11, 13, 15. Eventually, as you can see, even if the stock did not move, if it just trades sideways, you would eventually make your max profit. Again, that's due to theta decay or time decay. We can capitalize off of that when we're selling options, and this strategy allows us to also do that. Now, to see our max profit here, which again is almost $45, we want the price of the stock at expiration to be above the strike of the put that we're selling. So again, here the strike of the put that we're selling is 564. So at expiration, we'd want SPY to be at 564 or higher for us to see our max profit. And so if we take a look, that would be right here. This is where 564 starts, or higher. That's where we would see our max profit. And then of course we see our break even here as well. And so again, you can see here what our profit or loss might be depending on the date or the share price. You can also change IV here to see kind of what might happen with changes in implied volatility. And remember, you can close out of this trade at any point in time. And I'll put a video in the description below where I show you guys how to close out of any single trade on Robinhood. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think. And I will see you guys next time.